The geopolitical landscape of the Middle East has just suffered a catastrophic rupture. Iranian state media has officially confirmed that Supreme Leader Ali Khamenei has been killed following coordinated United States and Israeli airstrikes. According to the state broadcaster, the Supreme Leader has reached martyrdom. In a separate, equally devastating strike, former Iranian President Mahmoud Ahmadinejad was also killed. This is no longer speculative chatter. This is official confirmation from both Iranian media and Western outlets like Fox News. Two of the most powerful and polarizing figures in the Iranian regime have been removed from the board in a single coordinated operation. While some analysts initially hoped that the death of Khamenei might lead to a de-escalation, the exact opposite has occurred. Since yesterday, Iran has launched a massive retaliatory wave consisting of 165 ballistic missiles, 2 cruise missiles, and 541 drones. While Israeli and coalition forces intercepted 152 of those ballistic missiles and 56 drones, 35 drones successfully made land, with 21 striking civilian targets. Just this morning, the United Arab Emirates has been turned into a war zone, with 3 people killed and 58 injured across various nationalities. But here is the open loop that the mainstream media is too afraid to broadcast. Iran has now targeted the United States aircraft carrier Abraham Lincoln with 4 ballistic missiles. The Iranian Revolutionary Guards have confirmed the strike via state media. While the Pentagon remains silent on whether those missiles connected or were intercepted, the message from Tehran is clear: there are no longer any red lines. As the fires burn in the Persian Gulf, a silent financial shadow is moving across the global markets. While the Western exchanges were closed for the weekend, a dark market for gold emerged in the East, with prices touching levels that suggest a total monetary reset is already underway. We are about to look at a terrifying $6,000 gold print and the one asset that just hit a $27 premium in the streets of Shenzhen, signaling the death of the dollar-based pricing model. While traditional markets were sleeping, physical reality took over. Dasheng Bank in China has issued an emergency notice stating that if there is a big deviation in price, leading to a depletion of gold liquidity, trading will be closed immediately. A massive amount of yuan savings is currently sitting on the sidelines, waiting for the Monday market open. In the dark markets of Asia, gold has already touched $6,000 per ounce. On the crypto rails, the PAXG tokenized gold hit $5,600 yesterday and is currently holding at $5,400. That is a $124 premium above Friday's Western spot close of $5,278. But silver is where the true carnage is happening. In the Shenzhen physical markets, the buyback premium between small distributors has shot up by almost $20 per troy ounce. This puts the physical silver price in China north of $120 per ounce. Small distributors are flatly refusing to sell their inventory, fearing that they will never be able to replace the supply. On the weekend gray markets, silver is trading near $100 on IG, with Shanghai spot sitting at $105 and Shanghai futures at $108. But here is the open loop that should terrify every Western central banker. The gap between Western papers prices and Eastern physical prices has widened to a record $27. This isn't just a temporary arbitrage, it is a structural separation of the global financial system. 3 assets are now the only things that matter. Gold as a monetary reset hedge, silver as an industrial shortage play, and oil as an energy necessity. All 3 are spiking together while the world's most critical energy choke point, the Strait of Hormuz, is functionally shutting down. We are about to reveal the worst insurance frozen scenario that is currently trapping 20 million barrels of oil a day behind a wall of uninsurable risk, and the specific tanker that is currently on fire at the Qasab entrance. The Strait of Hormuz, where 20% of the world's seaborne oil flows, is no longer functioning. It isn't technically closed by a physical blockade, but it is frozen by insurance. Ships traveling through the strait must purchase war risk insurance to protect against attacks. If insurers refuse to provide coverage, which is exactly what is happening right now, the shipping companies cannot sail. It doesn't matter if the waterway is open if no one will insure the hull. 2 vessels are already on fire. A Palau-flagged tanker named Skylight was hit near the entrance, and a second ship named MKD Vion is currently burning. In response, insurance costs for a single $100 million tanker have jumped from $250,000 to $375,000 per voyage. Over 150 tankers have dropped anchor in open waters, refusing to move. Maersk has suspended all transits through the strait. Consequently, Brent oil prices are up 10% this weekend, holding at $80 per barrel. But Iran's strategy goes far beyond just the strait. This is a calculated maritime assault targeting the economic infrastructure of the entire region. They hit Duqm in Oman, a port specifically built to bypass the risks of Hormuz. They struck Jebel Ali in Dubai, which handles 60% of all imports for the UAE, effectively crippling the non-oil economy. They even attacked Mina Salman in Bahrain, the home of the United States Fifth Fleet. But here's the open loop that the military planners are struggling to solve. Iran is proving that you don't need to sink every ship to win an economic war. You just have to ignite the ports. The world's Patriot missile systems cannot protect every crane and every oil tank from a swarm of 500 drones. As the ports burn, a massive energy famine is beginning to take shape for the world's biggest importers. We are about to look at the Japan and South Korea collapse scenario, and why India is 48 hours away from a total fuel crisis that could trigger the collapse of the rupee. The nations that rely on Hormuz for their survival are currently staring into an abyss. These countries account for nearly 75% of all the crude oil that flows through the strait. Japan relies on the strait for 75% of its oil imports. Their tankers are already turning back. South Korea gets 60% of its crude through Hormuz, but India is perhaps the most vulnerable, sourcing 50% of its crude, roughly 2 million, 600,000 barrels a day, directly from the Gulf states. With fuel prices expected to skyrocket, the Indian rupee is under extreme pressure, and GDP growth is taking a direct hit. Even China, the world's largest absolute buyer of Hormuz crude, is feeling the pain, though they have some diversification through Russian pipelines. Iran's port strategy is a textbook example of asymmetric warfare. They aren't trying to win a naval battle against carrier groups, they are igniting infrastructure that cannot be defended. This is where economic warfare meets energy warfare. But here is the open loop that the metals market is currently pricing in. On Friday, we saw $650 billion added to the metals market cap as China ordered its citizens to leave Tehran. Markets are now pricing in a regime change scenario. Israel has explicitly stated that regime change in Iran is now the goal. If this becomes a sustained military operation with regime-ending objectives, we're no longer looking at a spike in prices. We're looking at the permanent destruction of the old paper pricing system. The structural deficits in silver and gold were already breaking the system before the first missile was launched. Now, those deficits are meeting a fear flow that has no ceiling. We are about to look at the 10 consecutive monthly green closes on silver and why the next 48 hours will decide the fate of the COMEX and whether the paper slams have finally lost their power. The structural foundation of the metals market was already in a state of collapse before the war began. Silver has seen 10 consecutive monthly green closes, and gold has hit its 7th straight record high. The Shanghai Premium was already at $12. It has now widened to $27 in Shenzhen. Industrial demand from solar, electric vehicles, and AI data centers hasn't stopped, but mine supply simply cannot keep pace. Central banks are still buying gold at record rates, and silver lease rates have been spiking for 6 days straight. When Western markets open tonight, you need to watch 4 specific things: the gap size on gold and silver futures, the Shanghai Premium, the duration of the airstrikes, and whether the Hormuz freeze stabilizes or expands. The resistance case, the argument for why prices might fall, is based on the idea that the banks will coordinate a massive paper slam on Monday to offset the weekend gains. This has happened during past geopolitical events. However, Iran's no red lines policy makes this time different. The airstrikes are expected to continue for days. Iran has hit United States bases in 5 different countries. The Houthi rebels are resuming attacks in the Red Sea. This is not a one-off event. It is a sustained multi-front military operation. But here is the open loop that proves the physical. Buyer has already won. The people in Shenzhen paying $120 for silver are not speculators who will panic sell if the COMEX drops the price by $5 on Monday. They are buyers who need the metal for survival and industry. The informed money has already moved. While the COMEX was sleeping, tokenized markets showed you the real-time price discovery. When the arbitrage between paper and physical becomes this large, $27, it becomes impossible to ignore. We're about to reveal the Monday morning gap strategy. And the final data point that proves the oil market is about to hit triple digits. As we move into the Monday open, gold is likely to lead the safe haven flow, but silver is the shortage play that will provide the most violent moves. The physical-backed crypto markets like Kinesis and Hyperliquid are already showing silver at $100. These are not random numbers. They are the preview of where the futures markets need to open for the arbitrage to remain functional. If the COMEX opens significantly lower than the physical price in Asia, we will witness the largest arbitrage drain in the history of the exchange. The Strait of Hormuz is functionally frozen. Actual insurance pricing in tankers anchored in open water are the hard data points, not the headlines. Underneath all of it, the structural deficits that were breaking the system in 2025 are now reaching their breaking point in 2026. The global supply chain cannot absorb $80 oil when 20 million barrels are stuck behind a wall of uninsurable risk. We are staring at a structural energy famine that will reprice every manufactured good on the planet. But here's the final open loop that proves the game has already shifted. As the UN savings flow into the gold market on Monday morning, rumors are circulating that a major BRICS nation is about to announce a gold-linked settlement for all oil exports. If a single major producer stops accepting paper currency for their energy, the petrodollar doesn't just decline, it vanishes overnight. What happens to the Western banking system when the world's energy is priced in the very metal they have been trying to suppress for decades? The answer is already visible in the Shenzhen premiums. This is no longer a drill. This is the monetary reset in real time. Invest with logic, not hype. OG out and about.